We had a few questions today about a tweet on the Shavaco Capital Twitter feed. In this brief video, we'll look at a risk-reward analysis using DeMark indicators for risk-on stocks, SPY, relative to risk-off, or the AGG bond ETF. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. The tweet was based on this daily DeMark chart. DeMark charts and indicators are proprietary tools from Market Studies LLC. This is a daily ratio chart of the SPY ETF relative to the AGG, aggregate bond market ATF. So we're looking at the ratio of stocks to bonds. When the ratio is rising, stocks are in favor relative to bonds. When the ratio is falling, bonds are in greater demand relative to stocks. If you know DeMark or follow our work, you know that a 9 paired with a 13 can be an exhaustion signal. And what it tells us, how we use this, when we see a 9 paired with a 13, the probability of a trend reversal increases. You can see on this ratio, SPY relative to AGG, we had a 913 on the sequential count come into play on March 1st of this year. Now let's look at some of the historical times where we've had similar signals. This is one of them here, which is January 3rd of 2013. Now we're looking at a longer-term daily chart of the S&P 500 index. And these dates that we have noted here are dates where we've seen a 913 sequential exhaustion signal on the ratio of SPY relative to AGG, or stocks relative to bonds. We have one in force now. The last one came on January 2nd, 2013. You can see the S&P 500 here did take a little dip, but not that great a signal in this case in terms of getting out of stocks and moving into bonds. However, you have to understand the context of the 913s, and I won't go into that now, but the context of this 913 is one that we're paying attention to. We'll respect it. We'll see how it plays out. Doesn't mean we sell all our stocks and get into bonds. It just means we're a little more careful here. Signal came on September 14th. The exact peak of the S&P 500 was an excellent risk-off signal. One came on April 30th, 2012. S&P 500 basically tanked. March 12th, 2012. You can see it is a good risk-reward signal. Here's your reward. Here's your risk in that case. February 13th, 2012. Again, you have to understand the context of the 913s. But you did get some consolidation here with the S&P 500. January 4th, 2012, in this area here, again, you have to understand the context. DeMark signals are not infallible. DeMark is not infallible. No indicator, MACD, RSI, no system works all the time. Every system is a probabilistic system. And you'll see here on these signals, these tend to be signals that we should pay attention to. One came on April 26, 2011. Very poor risk-reward time for stocks. January 4th, 2011. You can see we did get a little blip there. November 5th, 2010. The market corrected sharply and then rebounded. October 8th, 2011. If you look here, we went up and then we retraced all of the gains. So this ended up being a useful signal in the short term, even though the trend was strong going forward for stocks. And another signal came pre-flash crash, sending up a warning flare on April 5th, 2010. The market did go up, but it quickly retraced all the gains. You can see here, this is your reward This is your risk. Now let's flip over and just quickly scroll through and actually look at these signals so you can see them. Now we're looking at the DeMark chart again. We already went over these two signals. Let's scroll back. There's a 9 here paired with a 13 here that's tough to see. The 13 came on September 14th, 2012, which is the actual day that the S&P 500 peaked. We went from risk on to risk off. Come back here. Got another 13 that is similar to the 13 that we have now. On April 30th, 2012, we went from a short risk-on period to sharp risk-off. This tells you here that stocks are underperforming bonds after the 13. Here we have one on March 12th, 2012. And if you think of the risk-reward ratio in stocks, it's very poor here. Here's your reward relative to bonds. Here's your risk. Come back here. This is the one for February 13th, 2012. You can see risk on went up and then retraced all of those gains. So all of the gains that were made after the 13 were fully retraced in the ratio. Come back here. This is what's known as a deferred count. And if you know DeMark well, sometimes you take the deferred counts with a grain of salt. Not always. But in this case, we had a 13 come on January 4th, 2012. Again, you have to understand the context of the signals. Here, a 9 paired with a 13 came on April 26th, 2011. Here's your reward, your risk here. In fact, the market went here, really all the way down, and really had a rough time after that. Here's a signal here on January 4th, 2011. We did retrace a little bit and then went higher. One came again on November 5th, somewhere right in that range, 2010. A significant and sharp correction followed. Here, October 8th, 2010. We went up and then quickly retraced those gains. Coming back here, pre-flash crash, April 5th, 2010, the market went up. Our stocks were stronger than bonds for a few more weeks, couple of weeks, but your reward was here and your risk was here. How we use these signals? They're probabilistic signals, and the signal that we have today just tells us to pay close attention to risk management here. And as long as this ratio remains below this level here, we'll respect it. If we go above it, it doesn't discount the signal. A lot of things have to happen in DeMark. But if we go above it and stay above it, the probability of the 9 and 13 being an excellent signal start to decrease. As we sit now, as of the close, on Tuesday, the 9 and 13 is in place, and we'll pay attention with a close eye in terms of looking at risk on versus risk off. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shravaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.